Okay, hello everyone, and welcome to day 3 of the webinar. Okay, so in today's session, we will be focusing on an area that is called interest rate risk management. Okay, in the last session, we discussed about the currency risk management, and today we will be discussing interest rate risk management. As I told you in the introductory class, that on day 1, we plan to cover some appraisal stuff, day 2, the currency risk management, day 3, the interest rate risk management. After we're done with this, then day 4, we plan to do option pricing theory, Black-Scholes, and day 5, some merger stuff. Okay, now, obviously, we try to answer questions of students during the webinar. After every 15-20 minutes, I tend to ask students to write down their questions, and you people ask questions. Okay, but obviously we have made a WhatsApp group also, so that you can ask questions even after the class, and there are many students who send some questions, and we try to be as responsive as possible. But one thing I told you on day 1, you need to take care of that. Okay, since you are in the quantity of hundreds, okay, so everybody faces problems in separate areas. Like someone faces problems in risk management, so there is no guarantee that everyone is going to face problem in risk management. Someone might be concerned with mergers, someone might be concerned with small topics. So obviously, you know that this is just a 15-hour session. So in this 15-hour session, we try to only focus on the core important areas, which definitely come in the exams. Okay, the areas which sometimes come, sometimes don't come, they are difficult to get covered. However, the reason for WhatsApp group is that you all have my number in that group as well. You can just drop me a personal message. We have some video lectures as well, so we can help you out as much as we can. Okay, now in today's session, we are going to cover interest rate risk management. Okay, now remember when we focused on the currency risk management stuff in the last session. Okay, I told you all one thing, that we will discuss currency risk management later. I first want to tell you what basically is interest rate risk. Okay, we will discuss interest risk management later, interest rate risk management later. First, I want to discuss with you what is interest rate risk. Okay, so basically, what is interest rate risk? Interest rate risk is the risk that when we plan to borrow, the interest rates rise. Okay, and when we plan to deposit, interest rates go down. Okay, remember in the last session I told you about currency risk. Okay, that currency risk is the risk that currency rates go up when you have to pay, and currency rates go down when you have to receive. Now ignore this. You know, like the currency rates, interest rates also frequently change. Interest rates also frequently change. There is no guarantee that if interest rate is 5% today, okay, it is gonna be 5% forever. No, interest rates also do tend to change. So what exactly is interest rate risk? Interest rate risk is the risk that if you plan to borrow money after 4 months, a person will always be afraid, will always face this risk that interest rates may go up. And let's suppose we plan to deposit some money after 6 months. A person is always concerned that interest rates may go down. Like, for example, in January 2021, I plan to borrow some money to expand my business. I'm always facing this risk. I always face this risk. I'm afraid that interest rates may go up at that time. Let's suppose I plan to deposit some money in February 2021. I'm always afraid. I'm always facing this risk that at that time interest rates may go down. So this risk that interest rates may go up if you need to borrow, or interest rates may go down if you need to deposit, this is called interest rate risk. Okay, like currency risk, it is practically impossible to eliminate interest rate risk. you need to minimize or manage interest rate risk. And to minimize or manage interest rate risk, you use some risk management hedging techniques. Okay, it is not possible to eliminate currency risk. It is not possible to eliminate interest rate risk. You can only manage or minimize it through some hedging techniques. Now, the most commonly used hedging techniques in interest rate risk management are FRAs, called forward rate agreements, okay, interest rate futures, and interest rate options. There are some other techniques as well, like collars, like swaps, but the core techniques, again, we are focusing on core areas. The core techniques to minimize or manage interest rate risk are FRAs, forward rate agreements, interest rate futures, and interest rate options. Okay. Now, again, like the yesterday's trend, I will firstly tell you all about what is FRAs, what is interest rate futures, what is interest options. I will discuss with you the formats of them as well. I have very easy formats for all of them. Like you all were very happy after yesterday's session that currency risk management, you got some easier methods. The same manner, you will get some easier patterns regarding this as well. Okay, so let's start. To minimize or manage interest rate risk, there are three techniques called FRAs, interest rate futures, and interest rate options. Okay, let's start. FRAs. Now, FRAs stand for forward rate agreements. FRAs stand for forward rate agreements. Okay, what are FRAs or forward rate agreements? They are just like forward exchange contract. The mechanism is just like forward exchange contracts. The mechanism is just like forward exchange contracts. Now, how does FRAs work? What happens in forward exchange contracts? You tend to fix a currency rate for future transaction, right? This happened in forward exchange contract. No need to write this. This happened in forward exchange contract that you fix a rate for future transaction. Like for example, I have to pay $1,000. I have to receive $1,000. Fix a rate. This is forward exchange contract. Now FRA works on the same mechanism, but with interest rates. Okay. In FRA, let's suppose you plan to borrow in November. Let's suppose you plan to borrow in November. What is the risk? The interest rates may go up. If you plan to borrow in November, what is the risk? Interest rates may go up. You fix a rate. You fix a rate. Okay, let's suppose you're afraid that interest rates may go up. You fix a rate with a financial institution or bank. Let's suppose you lock the rate at 10%. This is FRA. That rate is fixed. What happened in forward exchange contract? The currency rate is fixed. What happens in FRA? Interest rate is fixed. Okay. Let's suppose you plan to deposit in Feb 2021. What will be your risk? The interest rates may go down. So what happens with FRA? You fix the rate. The rate is locked. No matter whatever way the interest rates now fluctuate, you have fixed a rate. When you fix currency rate, this is called forward exchange contract. When you fix interest rate, this is called FRA. Okay. Now, before moving towards working of FRA, I want to tell you two rules of FRA. Okay. Before moving towards the workings of FRA, I want to tell you two rules of FRA. Rule number one, if it's written FRA is 3-7, what is the meaning of this? If it's written FRA is 3-7, it means agreement will start in 3 months. The first digit is the starting time period. The agreement will start in 3 months. And the lasting period is denoted by the gap. Will last for the gap 4 months. Okay. Many people interpret it like that, that if FRA is 3-7, agreement will start in 3 months and last for 7 months. No, that's not the rule. FRA 3-7 means agreement will start in 3 months. The first digit is for start and will last for the gap 4 months. Okay, repeat. Let's suppose someone says FRA is 5-8. What does this mean? This agreement will start in 5 months and last for the gap 3 months. Okay. If someone says FRA is 6-10, what does this mean? Will start in months and last for the gap 4 months. Okay, this is rule number 1. That if FRA is 7-9, will start in 7 months and last for the gap 2 months. Okay, and rule number 2. If 2 rates are given, 6% that's 6.5%. In currencies, 2 currency rates were given and it was difficult to guess buying selling rate. Okay, similarly in interest rates, when 2 rates are given, remember the lower one is always the deposit rate and higher one is always the way. To learn this, it can't happen any other way. Like in currency rates, there was a chance that sometimes lower is buying, higher is selling, and higher selling, lower buying. No, in interest rate, risk gets fixed. If there are 2 rates mentioned, 2%, that's 2.5%. Remember always lower is the deposit one, higher is the borrowing one. It can't be the other way. The higher can't be deposit, the lower can't be borrowing. Why? If lower is borrowing, higher is deposit, you will just borrow from the bank at lower rate and deposit at higher rate. It's practically not possible. If 2 interest rates are mentioned, the lower is always the deposit one and higher is the borrowing. Okay, so FRA fixes an interest rate. Okay, you need to borrow a deposit, you can fix the rate. There are 2 rules of FRA. 3-7 start in 3 months, last for gap 4 months, and 2 rates are given. Lower is the deposit, higher is the borrowing. I can take any questions here. Sri Kotaria, you just need to click on the WhatsApp group link and you will join the group. Noman, obviously we have to focus on questions, okay? However, you can take help regarding that from WhatsApp, okay? So if Anwa, I told that when 2 interest rates are given, like 6% and 6.2%. So it's always the case that lower will be the depositing rate and the higher will be the borrowing rate. That's always the case, okay? Why so? It can't be the other way around. Let's suppose lower is the borrowing rate and higher is the deposit rate. A person would go to bank. Lower is the borrowing rate. He will borrow at lower rate and he will deposit to the bank at higher rate and start making money. That can't be the case. So that's why lower is always the deposit one and higher is always the borrowing. Okay. And the first rule, when we say that FRA is 3-7, so 3, the first number, it's when it will start. Agreement will start in 3 months. And for how long it will last, the gap shows for how long it will last. It will last for 4 months. Okay. Similarly, if it states agreement is 5-8, so 5, the first date, it will start in 5 months and last for the gap. What is the gap? 3 months. Similarly, if it states that the agreement is 6-10, start in 6 months and last for the gap 4 months. Okay. Okay. Now, what is the working format of FRA? What is the working format of FRA? Now, for FRA, you need to take the following formula. Actual return / cost on borrowing or deposit. I am not sure you will be getting a borrowing case or a deposit case. So that's why the format made covers both. You need to take actual return on deposit if it's a deposit case, or actual cost of borrowing, it's a borrowing case if it's a borrowing case. Because if it's a borrowing case, we have to take incur cost. So cost on borrowing, or if it's a deposit case, return on deposit. So cost of borrowing or return on deposit. How will you get the actual cost of borrowing or return on deposit? It's the amount, whatever is the amount, into actual rate of interest into time period over 12. Let's suppose you need to borrow a deposit for 4 months. So time period is 4/12. If you need to borrow a deposit for 6 months, that's 6/12. Okay. Then you need to add or less benefit or loss due to FRA. The benefit or loss due to FRA is computed as difference in interest rate into amount into time period over 12. What is this difference in interest rate? Obviously, the actual interest rate would be somewhat else. And in FRA, you fix some rate. So you need to check whether you got benefit or loss due to FRA by taking the difference in rates into amount into time period over 12. You get net cost of return. Now, what is the problematic stuff here? Kindly pay attention. What is the problematic stuff here? The problematic stuff here is that when you take actual return on deposit or cost on borrowing, it's very easy. Amount into rate of interest, actual interest rate into time period over 12. In benefit or loss due to FRA, people try to rote learn whether to add it or deduct it. No one can teach you this through rote learning whether to add or less it. The formula is simple, difference in interest rates into amount into time period over 12. The formula is simple, but no one is going to guide you, and no one can, in fact, whether to add or less. Now listen carefully. You need to judge it by taking the difference in interest rates, whether it's a benefit or a loss. And surprisingly, benefit or loss can be added as well as deducted. This benefit or loss can be added as well as deducted. How? Let's suppose you got a benefit. Okay. Now, if in the above transaction, the first transaction, you have taken actual return on deposit, you have mentioned return here, the one I'm highlighting. Let's suppose you have mentioned return here, the one I'm highlighting. And then in the second transaction, you just that you have got benefit. So benefit will increase return. Benefit increases return, you need to add it. However, if in the highlighted first transaction, you have taken actual cost on borrowing, you have got a borrowing case. So you've taken actual cost on borrowing. If you have taken actual cost on borrowing and you judge it's a benefit, benefit always reduces cost. You need to deduct it. Okay. So if I don't know, you will be getting a deposit case or a borrowing case. You have to be prepared regarding both. But if it's a deposit case, you get return on deposit. And if you just there is a benefit results in increased return, so you need to add it. However, if the case is cost of borrowing, so benefit reduces your cost deducted. Same goes the other way. Let's suppose in the second transaction, you judge that you have got a loss due to FRA. You can add loss as well as deduct loss. Depends on the first transaction. If you have taken cost on borrowing, you got a borrowing case, and in the first transaction, you wrote cost on borrowing, and then you judged it's a loss. Loss increases cost, you need to add it. Loss increases cost, you need to add it. However, if you got a deposit case and you wrote return on deposit in the first transaction, so if you wrote return on deposit and then you got loss, loss reduces return deducted. You will get net cost or return. If it's a borrowing case, you will get cost. If it's a deposit case, you will get return. Okay, so these are the two steps of FRA. You need to first note the return on deposit if it's a deposit case, or cost on borrowing it's a borrowing case. The formula is mentioned, and then the main thing, benefit loss due to FRA. Many students make mistakes in that. Take the difference in rates. What is the rate and what you got? Judge it whether it's a benefit or loss into amount into time period over 12. Benefit, if it's deposit, it increases return. Add it. If it's a borrowing case, cost of borrowing, the benefit reduces cost deducted. If it's a loss, loss increases cost. So in case of cost, add it, but loss reduces benefit. In case of return, deducted. Okay, I can take any questions here and then move towards futures. Bilal, I will share it, don't worry. Bilal, how is that possible? You are ignoring the currency conversion aspect. Yes, you are right, Noman. Okay, Fanwa, I will repeat it. Okay, I will repeat about benefit and loss, don't worry. Okay, there are two or three messages for repetition. I will repeat it, don't worry. I'll just take some other questions as well. Yes, Mira, you are absolutely correct. Sandon, you need to wait, obviously. Once we discuss the formats, we will be doing a question in which we will apply all the formats, don't worry. So Rikotale, everything is in the notes. You don't need to worry about copying. Okay, on request of few students, let's repeat it. So FRA is a contract of rate fixation in which we fix interest rates. Okay, we don't fix currency rates. That's a forward exchange contract. We fix interest rates. Okay. So we take actual return on deposit or cost on borrowing. Okay. So how do we take actual return on deposit or cost on borrowing? Okay, it's simply the amount you need to borrow deposit into rate of interest actual into time period over 12. Okay. You may be getting a deposit case, so return on deposit, you may be getting a borrowing case or cost on borrowing. Okay, then benefit or loss due to FR. You need to judge by taking the difference in interest rates into amount into time period over 12. It's a benefit or a loss. But whether to add it or deduct it, that's completely depending on the scenario. Let's suppose you got a deposit case. So what do you wrote above? Let's suppose you got a deposit case. What did you wrote above? Return on deposit. You wrote return on deposit in the highlighted area. Now you got benefit. You got benefit. So benefit increases return. Add it. Okay. But let's suppose you got a borrowing case. So what did you wrote above? Cost on borrowing. And then you judge you got benefit. So what happens is benefit reduces cost. So deduct the benefit. Okay. Let's suppose you got a deposit case. So what did you wrote in the first step? Return on deposit. And then later you judge you got loss. So what happens? You wrote return on deposit and you suffered loss. Loss reduces return, so deduct it. Loss reduces return, so deduct it. Okay, but let's suppose you wrote cost on borrowing above. You are a borrowing case, you wrote cost on borrowing, and then you judge you got loss. So in the first step, you wrote cost on borrowing, and then you got loss. So what happens is loss increases cost, so add it. Okay, you got net cost return. You have to judge it yourself whether it's a benefit or a okay. Okay. Now interest rate futures. As far as interest rate futures is concerned, it's the same principle like currency futures. We fix a rate, but standardized contracts. We don't get the commitment for our own amount. It's standardized. Contract size is standardized. Okay, and the interest rate options, the next one, same options. That you fix a rate, but it's a right, not an obligation. Okay. Now, how do we do interest rate futures? Now, interest rate futures is the most important and carries the most marks. You saw FRA. It's just a single two-step approach, but interest rate futures is lengthy. It carries more marks, therefore pay attention, and you're likely to get it completely by doing the question. You can only back away from options, Mira, no other option. Yes, Ossiper, if you have a cost of borrowing and then you get a benefit, so obviously benefit reduces cost. So you need to deduct it. No, Faizan, they're different. Ishrat, you have to wait because once the format is done, we will be doing examples, don't worry. Because we will be discussing the format of interest rate futures and then options and then go towards the question, okay? Okay, in interest rate futures, first remember the strategy. In borrowing, the strategy is sell now, buy later, okay? And in deposit, the strategy is buy now, sell later. In borrowing, the strategy is sell now, buy later. And in deposit, the strategy is buy now, sell later. Okay, so what is the format? The strategy needs to be learned like in yesterday's session, you learned that in payment case, we have to buy, so buying rate, and in receipts, we have to sell, so selling rate. In interest rates futures, the strategy in case of borrowing is sell now, buy later, and in case of deposit, it's buy now, sell later. Okay. So what is the format of interest rate futures? Step one. Interest rate futures requires 8 steps to be shown in exam. Requires 8 steps to be shown in exam. Okay. The first step, find number of contracts. What is the formula of number of contracts? It's borrow or deposit amount over contract size into time period of borrowing or deposit over 3. Okay. In the second step, you need to find basis risk. It's basis, right? The formula of basis risk is spot price minus LIBOR less futures price. Futures price would be given. Okay. Then in the third step, you need to show unused basis. It's basis risk into extra months over total months. Okay. Now, what is this basis risk and unused basis? You just see here. I will shortly explain it to you via question. Just see the steps first. Find number of contracts. It's borrow or deposit amount over contract size into time period of borrowing or deposit over 3. Then you need to find basis risk. It's spot price minus LIBOR less futures price, that would be given. Then you need to find unused basis risk into extra months over total months. Then find future closeout price in both cases. What is this both cases? Now in the exam question, you are likely to be provided with 2 cases. Case 1 would be interest rates are rising, and case 2 would be interest rates are falling. In the exam, it is likely that you are provided with two cases. Okay. In the first case, interest rates will be rising, and in the second case, interest will be falling. You will be very lucky if you're just provided with one case. Then obviously in that case, future closeout price is in one case. But in the majority of the questions, 90% questions, you're provided with two cases, interest rates increase and decrease. So you need to find future closeout price in both cases. Increase, decrease. How do you find future closeout price? It's spot minus LIBOR less unused basis. Unused basis was computed in step 3. Okay. In step 5, you need to find tick size if not given in question as contract size into 1 over 10,000 into 3 by 12. Now people ask, what is this tick? Again, in majority of the questions, tick is given. If tick is not given, step 5 states you need to find tick as contract size into 1 over 10,000 into 3 by 12. What is tick? Now tick is basically how or in what proportion prices can change. How or in what proportion prices can change. Okay. How or in what proportion prices can change, that is tick. Let me explain to you through an example. Now, if you see US stock markets, let's suppose the price of a share is $1. How can the prices move? It becomes 1.1, 1.2, 1.3, 1.5, 1.9, 0.8. The prices can fluctuate just by 0.1 each. The tick of US stock markets is 0.1 because the prices can change by 0.1 only. It can be 1, 1.1, 0.9, 0.8, 0.7, 1.5. The prices can change in the lots of 0.1, 0.1. It can never be the case that if a share is for 1, it can be of 1.02, not possible, or 1.03, not possible, because the tick, the fluctuation level is 0.1. So shares prices can move by 0.1 each. It can never go beyond that. Okay. Similarly, if you look at international gold rates, it's just for reference, okay? The actual situation may vary. Now let's suppose the international gold rates are $1,900. The international gold rates are $1,900, for example. You know the tick of gold markets is $1. The tick of gold markets is $1. That means gold rates can move in lots of proportions of $1. So if gold rate is 1900, it can be 1901, 1902, 1899, 1888, 1885, 1905, 1906. It can never be the case that gold rates are 1900.2 or 1900.5. They cannot move by 0.2. They cannot move by 0.5 because the tick, the fluctuation lot is $1. So it can move in pieces of 1, like 1900, 1901, 1902. So that is tick. Again, in questions, it would be given, but if it's not given, the format states, the marking scheme states, you need to find the tick also. So format states find number of contracts, borrow or deposit amount over contract size into time period over 3, then basis risk, spot minus LIBOR less futures price, then unused basis, then find future closeout price in both cases, increase or decrease, then find tick. Step 6. Find outcome of hedge in case of LIBOR increase decrease. You need to find the outcome of hedge in case of LIBOR increase or decrease. Again, firstly, you need to write the actual cost of borrowing or actual return on deposit. It's easy. The actual cost of borrowing if it's a borrowing case, or actual return on deposit if it's a deposit case. Amount into interest rate into time period over 12. It's very easy. Again, add or less gain or loss on futures. Again, gain or loss due to FRA. In the previous technique, gain or loss due to FRA. You have to judge its gain or loss. It can be added or deducted. Similarly, here you have to show gain or loss on futures. So it's difference in futures price and future closeout price. Okay, you have to judge that's gain or loss into spot, into number of contracts, into tick. Again, gain can be added or deducted, loss can be added or deducted depending on if it's cost of borrowing. Loss increases cost, add it. Gain reduces cost, deducted. But if it's a deposit case, get return on deposit. Loss reduces return, deducted. Gain increases return, add it. You get net benefit or cost. Okay. And then in the last step, you need to find the effective interest rate. Effective interest rate is the last step in which you take net cost or net return over borrowed or deposit amount into 12 months over time period of borrowing or deposit. Obviously, it's not practically possible that you just see the format and you grasp everything. It's not possible. But it's just a matter of one question. In one question, you will be applying the format. And I'm telling you, once you do that question, it would be really easy for you to handle this futures thing. Okay. Format of futures is you need to find number of contracts, it's borrowed deposit amount over contract size into time period over 3. Then you need to find basis risk, then unused basis, then future closeout price. What is this basis risk or unused basis? I will tell you. Then you need to find future closeout price in both cases, spot minus LIBOR less unused basis. Then you need to find tick, outcome of hedge. The first transaction is very easy. Actual cost of borrowing, return on deposit depends on cost of borrowing or return on deposit case, amount into interest rate into time period over 12. Then you need to judge whether it's a gain or loss, and to add or subtract, you get net benefit or cost and the effective rate. Okay, so now the last technique, interest rate options, and after that we will be moving towards the question. If you have any questions regarding futures, please ask. Yes, Seth, you're right. Yes, Abby. At Rito, we are selling the contracts and buying it later. Step 8 is the effective interest rate. Now, what is the effective interest rate? Effective interest rate, sorry, the 7th step. I mistakenly told the step 8. The 7th step is the effective interest rate. You just need to convert your answer into percentage, the effective rate. Huda, I will tell you how to calculate the unused basis. Okay, what I'm going to do is that I will repeat these 7 steps, and no need to note. I'm just sending you this file to all of you. Just wait. Okay, I've shared this file on the WhatsApp group, okay? FNY, actually, when we will solve, we will focus on each step. And at the moment, the objective is just to read them. Then what are the steps? Obviously, when we will solve the question, we will be really dealing that. Tick, I'm repeating tick, and together with that, I'm repeating the 7 steps. If you please pay attention once again, so that everybody who has problem in every step, he can get clearance. Okay, so in interest rate futures, the strategy in borrowing is sell now, buy later, and in deposit, it's buy now, sell later. Okay. So we have to show 7 steps. The first step is number of contracts. It's how many contracts you need to take, borrow a deposit amount over contract size into time period of borrowing or deposit over 3. Then you need to find basis risk. It's spot minus LIBOR less futures price that will be given. Then you need to find unused basis, the basis risk into extra months over total months. Then you need to find future closer price in both cases. Increased interest rate case, decreased interest rate case. It's spot minus LIBOR less unused basis. Then you need to find tick size if it's not given in the question. It's contract size into 1 over 10,000 into 3 over 12. Now, what did I tell you about tick? What exactly tick is? Tick basically reflects the minimum fluctuation lot, how prices in international markets, gold, commodities, stocks can fluctuate. I gave you example about US stock markets, that if a share is priced in US markets at $5, the tick is 0.1. That means the shares price can only be fluctuating by 0.1 each. So it can be 4.9, 4.8, 5.2, 5.3. There can never be an instance where the price becomes 5.001, 5.02, because the prices can minimum fluctuate by 0.1. That's it. Similarly, I gave you example about international gold markets. Like in gold markets, the gold rates are 1900, but the tick of gold markets is $1. That means prices can move by $1 each. So you can never see that gold markets become, the gold rate becomes 1900.4, 2001.32. No, it can be 2000, 2001, 2002, because the minimum fluctuation lot is 1 each. Then you need to find outcome of hedging in case of LIBOR increase, decrease. You need to find outcome in both cases, okay, increase as well as decrease. Actual cost of borrowing, if it's a borrowing case, or actual return on deposit, if it's a deposit case. Same amount into interest rate into time period over 12. Then we need to add or less the gain or loss on futures. How do you get the gain or loss on futures? It's same like gain or loss on FRs. The difference between FR rate and the actual rate. Similarly, difference in futures price and closer price. Into spot, into number of contracts, into tick, you get net benefit or cost. And finally, you find effective interest rate. Just convert your answer in percentage, because we will take the decision on percentages. Abdullahi Koroma, all the materials are put in this handouts tab for day 1, day 2, day 3. So it's shared with everyone. You just have to click on the appropriate file. Yes, Abdullah, these 7 steps need to be followed. Just a second. I'm sending the WhatsApp link to some students who are still not in that group. Yes, sending, just a second, please. Once again, we have sent the WhatsApp group link to everyone. Sheikh Abi Said, there are handouts tab on your GoToWebinar tab. The notes are all in there. Everybody takes from there. Okay, now let's move towards interest rate options. See the format of interest rate options, and then we will be moving to the question. I've shared the link on sent to everybody. You can just click on the link to join the WhatsApp group, okay? And when we will be going on break today, so I will again send that this file which I am just sharing on the screen, so that you don't have to copy, you have the file with you, okay? Now in interest rate options, the first rule, the strategy. In case of borrowing, we take put option. In case of deposit, we take call option. Someone asked me what is the reason behind that. We just studied in borrowing, the strategy you just discussed, it's sell now, buy later. Right? So if the strategy is sell now, buy later, selling means take put option. While in deposit, your strategy you just discussed in the previous part, the strategy was buy now, sell later. So call option. Okay. Now this is the presentation format which you have to mention in the exam for options. This is the presentation format you have to show for options. Okay, you need to give heading of two cases. Case one, LIBOR increase. Case two, LIBOR decrease. There are bright chances you would get both cases in the question. In one case, LIBOR would be increasing. In the second case, LIBOR would be decreasing. Okay. Now the first thing you have to mention is exercise price of options. Then you need to compare it with future closeout price, get it from futures. Okay. Then you need to decide whether to exercise yes or no. I will tell you how to take this decision. But in the first step, you need to write exercise price of option. Then you need to compare it with future closeout price from futures. You need to decide whether to exercise or not. Yes, no. Then you need to write gain in basis points if yes. Then you need to write total gain. Then you need to write in step 6 actual cost of borrowing or actual return on deposit. Just copy paste it from futures. Actual cost of borrowing or actual return on deposit is already calculated from futures. Just copy paste it. And in the last step, you need to take the premium payable, because obviously when you follow options, in options you pay premiums as well. Okay, formula of everything is given. Again, you get net cost or net return depending on borrowing or deposit case. And finally, convert your answer into percentage effective rate. I have already told you the formula of effective rates above. Now, once you get effective rates of all three techniques, the FRA's features options, so you just need to compare all of them and decide which is the best one. Okay. Now, my formats are strictly in line with examiner marking schemes. So if in FRA you just write those two steps, actual cost of borrowing or return on deposit and gain loss due to FRA, that's it, you get marks. Obviously, correct answer marks. Then in interest rate futures, you have to show 7 steps. Okay, if you write those 7 steps and solve each and everything, you get marks. And in case of interest rate options, you have to make these 2 heads of increased case and decreased case and write these 8 things. Once you get these 8 things correctly, add this correctly, your answer gets okay. Okay. So before moving towards the question, okay, I am sending the file again on WhatsApp group so that those who join the group, I would advise you that I've sent the link again. Those who haven't joined the group, they can quickly add that so that I'm sharing the file again. And when I share the file again, you all get it. Okay, so I have shared the file again so that you don't need to copy this and you can get the ready-made notes. Osman, it's not possible. Obviously, interest rates would either be increasing or decreasing. If they are neither increasing nor decreasing, then you are not facing any interest rate risk. There is no need of risk management techniques. They have to increase or decrease. Only then you face risk. FNWA, I have just shared the WhatsApp link on the message. You just need to click on that and you can join the group. No, no one. Yes, Sri Kautalya, there are many questions in which a complete question was tested on risk management and it included both interest rate risk and currency risk. However, you should remain confident with one thing. There can be a possibility that interest rate and currency risk come in one single question. There have been instances where there is a single question in which both are tested, but they both were separate parts. In part A, the focus was completely currency risk, and in part B, the focus was completely interest rate risk. They cannot merge. Currency risk has to be dealt in a separate part or separate question, and same with interest rate risk. You cannot get a merged question of both. Mohammed Yunus, you can use any separate approach. It's up to you. The reason why we are using such approaches is that I try to teach you the most easiest approaches that help you gain easy marks. However, if you want to attempt your own approaches, you are most welcome. There is no problem in that as long as answer coming is correct. Okay. Okay, so let's make a summary. That to minimize interest rate risk, there are three risk management techniques. The first risk management technique was FRA, which fixes a rate. Futures, this also fixes a rate, but they are standardized. And options, in which we fix a rate, but there is a right, not an obligation, we can back off. Okay. How do you perform FRA, futures, and options? I have told you the format. In FRA, the formula is just two things: actual return on deposit or cost of borrowing, depending on it's a borrowing case or a deposit case. The formula states amount into interest rate to time period over 12, and add or less benefit or loss due to FRA. How do you judge benefit or loss due to FRA? You take the difference in rates, what FRA provided you versus what you got, into amount into time period over 12. Accordingly, add or less benefit or loss accordingly, so you get the net cost or net return. Okay. In interest rate futures, the strategy you need to learn: in case of borrowing, it's sell now, buy later, and in case of deposit, it's buy now, sell later. In the first step, you need to show number of contracts. It's borrow or deposit amount into contract size into time period of borrowing or deposit over 3. Then you need to find basis risk. It's spot minus LIBOR less futures price, which will be given. Then it's unused basis risk into extra months over total months. Then future closeout price, in both cases increase, decrease, spot minus LIBOR less unused basis. Then tick size if not given in the question. Then the most important step: outcome of hedge in LIBOR, increase, decrease. You take actual cost of borrowing on return deposit, it's the same thing, amount into interest rate into time period over 12. Then you need to add or less gain or loss on futures, depending on what is the futures contract price and what price you got, into spot, into contracts, into tick. You get net benefit or net cost. Okay, accordingly add or less them. And then you need to find the effective rate, what is the percentage impact. Okay. In interest rate options, it's these 8 steps. In options, the borrowing case, take put option; the deposit case, take call option. Reason is given. The format presentation is you need to make 2 tables, 2 columns. One is the increase case, one is decrease case. Exercise price, what is the future closeout price? Decide yes or no. Gain in basis points if yes, total gain. Cost of borrowing or return and deposit from futures, the premium payable, get net cost of return, and the effective rate. Okay. Again, the question won't ask you any specific technique. Okay. The question will only ask you to recommend the best technique, and to recommend the best technique, you have to solve all 3 and then decide which is the best one. Like in the yesterday's question, the question didn't ask for any specific technique. The question only asked you to recommend the best one. Okay, so recommend which is the best one. I solved all 3, futures, options, and forwards, and then decided. Same here, it will ask you to recommend an appropriate strategy. You need to solve all 3 and then decide which is the best one. Okay, so I can take any questions, and if you have any questions, you can ask, and we will move towards the past paper question. Yes, Shilpa, you can do that. So we did this question number 1 in the first class. Question number 2 yesterday. That's question number 3. Okay. Okay, so if you don't want to use the question through this spreadsheet, it's up to you. You have the notes file, which is shared with all of you, and it's present in this handouts tab as well. You can view the question through that. And if you want to watch it through this CB platform, you can watch it through. Okay. I would request everyone not to ask questions on the WhatsApp group at the moment. You need to ask questions here on the questions tab. Okay, WhatsApp group shall be used after class, where we can communicate at the moment with each other through this questions tab. Okay, so I can't answer questions on the WhatsApp simultaneously as well. So you need to ask any questions here, and after the class timings, you can use that WhatsApp. Okay. Okay, let's start the question. A one company is expecting to receive 48 million on 1st February 2014. So Awan is planning to receive $48 million on 1st February 14, which will be invested until it is required for a large project on 1st June 2014. Due to uncertainty in the markets, the company is of the opinion that it is likely that interest rates will fluctuate significantly over the coming months, although it is difficult to predict whether they will increase or decrease. Awan company is expecting to receive, see the case carefully, Awan company is expecting to receive $48 million on 1st February 2014. They plan to receive $48 million on 1st Feb 14, which will be invested until required for a large project on 1st June 14. They will be invested until required for a large project on 1st June 14. Okay. Due to uncertainty in the markets, the company is of the opinion that it is likely that interest rates will fluctuate significantly over the coming months. Interest rates fluctuate significantly over the coming months, although it is difficult to predict whether they will increase or decrease. Okay. Awan's treasury team wants to hedge the company against adverse movements in interest rates using one of the following derivative products. Awan's treasury team wants to hedge the company against adverse movements in interest rates using one of the following derivative products: the FRAs, the futures, and options. Okay, so Awan's treasury team wants to hedge the company against adverse movements in interest rates using one of the following derivative products: the FRAs, futures, or options. Treasury team wants to hedge the risk through forwards, the FRAs, the futures, or options. Awan can invest funds at relevant interbank rate less 20 basis points. You can invest funds at interbank rate less 20 basis points. 100 basis points is 1%. 100 basis points is 1%. 50 basis points is 0.5%. 20 basis points is 0.2%. The standardized rule in banking sector, 100 basis points is 1%. Okay, so 50 basis points, 0.5%, 20 basis points, 0.2%. Awan can invest funds plus 20 basis points. The current interbank rate is 4.09%. However, Awan is of the opinion that interest rates could increase or decrease by as much as 0.9% over the coming months. Okay. Current interbank rate is 4.09. Awan company can invest funds at interbank rate less 0.2%. Interbank rate is 4.09. Awan is of the opinion that interest rates could increase or decrease by 0.9%. The following information and quotes are provided from an appropriate exchange on futures and options. Margin requirements can be ignored. 3-month futures are provided. 2 million is the contract size. Prices are quoted in basis points at 100 minus yield percentage. December 2013 futures prices are 94.8. March 2014 futures price are 94.76. June 2014 futures prices are 94.69. Okay, so 3-month futures are provided. 2 million is the contract size. Prices are quoted in basis points at 100 minus 12%. December 2013 futures are 94.8, March 2014 futures are 94.76, and June 14 futures are 94.69. Then options data is given. Again, 2 million is the contract size. Premiums are in percentage. There are two exercise prices or strike prices given, 94.5, 95. December, March, June calls are given. December, March, June puts are given. Only one column is relevant, as I taught you, and the figures in between are the premiums. Okay. Woblaka Bank has offered the following FR rates to Evan. There is a bank called Woblaka Bank. He has offered the following FR rates to Evan. 1-7 4.37%, 3-4 4.78%, 3-7 4.82%, 4-7 4.87%. Okay. Then it can be assumed that settlement for futures and options contract is at the end of the month, and that basis diminished to 0 at contract maturity at constant rate based on monthly intervals. Assume it is 1st November 2013. Now there is no basis risk. Okay. You need to assume this 1st November 2013. So that ends the question. Requirement. This highlighted requirement you need to read. Based on the 3 hedging choices Avan is considering. Remember, there are 3 hedging choices. See, go back to the question. Avan's treasury team wants to hedge the company against adverse movements in interest rates using one of the following derivative products: forward rate agreements, futures, and options. So the requirement states, based on the 3 hedging choices Avan is considering, recommend an appropriate hedging strategy for 48 million investment if interest rates increase or decrease by 0.9%. So based on the 3 hedging choices Avan is considering, recommend a hedging strategy for 48 million investment. See, the question didn't ask you for a specific strategy. The question only said, recommend a strategy for 48 million investment. Recommend a strategy for 48 million investment. So obviously when question asks you to recommend a strategy, you need to solve 3 and decide. FRS, futures, options, then you will recommend. In the currency question also, the question didn't ask that recommend solve futures or options, etc. Recommend a strategy. You need to solve 3 and then decide. So based on 3 choices that one is considering, recommend a hedging strategy. You need to solve all 3 FRS, futures, options, and then recommend and see if interest rates increase or decrease by 0.9. There are 2 cases: interest rates increase, decrease. Okay. Now before starting this question, I want you all to just continue with my screen, and we will be doing a quick recap of this question again so that we can start. I will give you tips and tricks on how to do this question. Okay. Okay. Question states, Avan company is expecting to receive 48 million on 1st February 2014, which will be invested until required for a large project on 1st June 2014. Okay. Avan is expecting to receive 48 million on 1st February 14. The dates are key. I will tell you a very easy strategy to do the question. Avan is expecting to receive 48 million on 1st February 2014, which will be invested until required for a large project on 1st June 14. It is planning to receive 48 million on 1st Feb 14, which will be invested. Invested means deposited with the bank. Invested doesn't mean borrows. Avan is expecting to receive 48 million on 1st Feb. It will be invested, deposited until required for a large project on 1st June. Due to uncertainty in the markets, companies of the opinion that it is likely interest rates will fluctuate, although it is difficult to predict whether they will increase or decrease. Avance Treasury team wants to hedge the company against adverse movements in interest rates using one of the following derivative products: FRAs, futures, and options. Then it states, Avan can invest funds at the relevant interbank rate less 20 basis points. The current interbank rate is 4.09. However, Avan is of the opinion that interest rates could increase or decrease by 0.9. The following information and quotes are provided from an appropriate exchange on futures and options. 3-month futures contract size is 2 million. Prices are quoted in basis points at 100 minus yield. December, March, June futures are given. Okay, with their prices. Options, there are 2 million contract size. 2 exercise price and strike prices are given. Like in yesterday's question, you have to take both prices, 94.5, 95. Calls are also given, puts are also given for December, March, June. Only one is relevant. Okay. Wablaka Bank has offered the following FRA rates: 1-7, 3-4, 3-7, 4-7. Okay. Requirement is based on the 3 hedging choices the one is considering. What are the 3 choices considering? Futures, options, and FRAs. Recommend a strategy for 48 million investment. If interest rates increase or decrease by 0.9, you need to solve 2 cases. Even if interest rates increase or decrease, you need to do both cases of 0.9. Okay, now let's start the solution. We will discuss one technique, FRAs, then we will take a break, and then we will do the other 2 techniques. Okay. So the requirement is based on the 3 hedging choices Avan is considering, recommend a hedging strategy for 48 million investment. You need to recommend an appropriate hedging strategy for 28 million investment. Okay. Now you know that there are 3 hedging choices the one is considering: futures, options, and FRAs. You need to solve all 3 and recommend for this 48 million investment. Now, obviously, I need to give you tips as well. My first tip, that's a golden tip. Now, before starting the question, okay, before starting the question, you need to write 5 things which will make the question a piece of cake for you. Before starting the question, you need to write 5 things which will make question a piece of cake for you. Okay. Now, this is the thing. You can just believe me, I'm giving you a golden. Before starting the question, if you are clear with these 5 things, I bet, I challenge, all these 5 things will be given in the question. You just have to pick and select. Your question will become a piece of cake. Okay. You need to write today's date given in the question, borrowing or deposit date given in the question, ending date till when we are borrowing deposit, case of whether it's a case of borrowing or deposit, and which future and option to take. Okay, so pay attention. I have to find these things. So what is the today's date? 1st November 13. Assume it is 1st November 2013 now. Today's date. Okay, done. Borrowing deposit date, that is also given in the question. Go back to the question. Awan is expecting to receive 48 million on 1st Feb 2014, which will be invested. Invested means deposited. Awan is expecting to receive 48 million on 1st Feb 14, which will be invested, deposited. So when are you planning to invest or deposit? 1st Feb 14. Okay. Ending date. At what date you will finish borrowing or depositing? What is the ending date? Till when we are borrowing deposit? Again, that will be given in the question. Awan is planning to receive 48 million on 1st Feb, which will be invested, deposited until required for a large project in 1st June. It will be invested till, deposited till required on 1st June. So you will deposit it until 1st June 2014. Case of, it's a borrowing case or a deposit case. Awan is planning to receive 48 million on 1st Feb, which will be invested. Invested means borrowed, deposited. Okay, and which future and option to take? See, in the question, you are given futures for December, March, June, and options for December, March, June. Which future and option to take? Okay, so always remember, when do you plan to borrow a deposit? 1st Feb. When do you plan to borrow a deposit? 1st Feb. You plan to borrow and deposit on 1st Feb. Futures and options are only available for 4 periods. December, March, June, September, every quarter. There is no other future option available. Futures and options are available for each quarter. December, March, June, September. That's it. No mid months. If you are planning to borrow or deposit on 1st Feb, you would most likely need a future option for 1st Feb, but there is no future option available for 1st Feb. So it's December, March, June, September. Which one you will take? 1st Feb is not available. You need to borrow a deposit on 1st Feb. So since futures options are only available for December, March, June, and September, you will take the March one. Let's suppose you have to borrow or deposit on 1st August. There is no future option available for August. December, March, June, September, every quarter. So if you need to borrow a deposit on 1st August, you have to take for September. And all these are for 30th, like December, March, June, September, 30th December, 30th June, 30th March, 30th September. Okay, they end on 30th of every month. So only 4 futures and options are available every quarter: December 30th, March 30th, June 30th, and September. So let's suppose you need to borrow or deposit for November. There's no future option available for November, only December, March, June, and September. So if November, you need to take for December. Okay. Before starting any interest rate question, note these 5 things. Today's date, given 1st November. When you plan to borrow deposit, it will receive 48 million on 1st Feb and then deposit 1st Feb. Till when? Until required 1st June. Case of deposit or borrowing. Deposit, and which future option to take? You need to borrow a deposit on 1st Feb, take for March. Any questions in these 5 things? Then I will move forward. No, Sri Kautale, that's not possible. We'll try, Yunus. Yes, Rakib will try. Yes, Usman, there is no involvement of currencies in interest rate risk management. So currencies won't be coming within interest rates. Futures contain the most marks. So because the earlier date would have passed. Evelyn, we have two cases in interest rate risk management. Either we will be tested the case of deposit or the case of borrowing. So you need to decide the cases of borrowing. The question is of borrowing or deposit. Okay. And if you need to borrow a deposit on 1st Feb, you have to take December, March, June, September. Which future option? Obviously, if you have to deposit or borrow on 1st Feb, take the next one. March 1. Yes, Princess, it's there. Okay. So once we get these 5 things, today's date, borrowing, deposit date, the ending date, what is the case? Now we will be starting our techniques. The first technique we are doing is technique number 1, FRA. We'll solve all, but at the moment we are doing technique number 1, FRA. Okay. There are 2 cases in the question. If interest rates increase by 0.9%, and if interest rates decrease by 0.9%, you can check the requirement. It's written above based on 3 hedging choices. The one is considering recommend hedging strategy for 48 million investment if interest rates increase or decrease by 0.9. You have to answer 2 things: if interest rates increase or decrease by 0.9. Okay, let's make the format of FRA. Okay, so the format is you take actual cost of borrowing or return on deposit. It's a deposit case. Return on deposit and gain loss due to FRA to get the net cost. Okay, in both of these, if interest rates increase or decrease by 0.9, you take the actual cost of borrowing or actual return on deposit, and the gain loss due to FRA, you get the net cost. Okay. So let's start. So what happens is, if interest rates increase by 0.9 and decrease by 0.9, you have to mention two things in FRA: actual return on deposit and gain loss due to FRA to get net cost or return. Net cost or return, it's a deposit case, net return. Okay, so let's start. Okay, now remember one thing. See my fingers. When do you plan to borrow a deposit? 1st Feb. Okay, when do you plan to borrow a deposit? 1st Feb. Okay, you plan to borrow a deposit or 1st Feb till when? 1st June. Today's date is 1st November. Now listen carefully. Today's date is 1st November. Today's date is 1st November. You plan to borrow a deposit on 1st Feb. See my fingers. Today's date is 1st November. You plan to borrow a deposit on 1st Feb. 1st November to 1st December, 1 month. 1st December to 1st Jan, 2 months. And 1st Jan to 1st Feb, 3 months. You need to borrow a deposit after 3 months. For how long? What is the ending date? 1st June. You plan to borrow a deposit on 1st Feb till 1st June. So 1st Feb to 1st March, 1 month. 1st March to 1st April, 2 months. 1st April to 1st May, 3 months. And 1st May to 1st June, 4 months. So you plan to borrow after 3 months, okay, and till 4 months. So the relevant FRA for you would be 3-7. This green highlighted one. Why? Again, this is not possible to do without looking at the dates. That's why I wrote the dates first. Okay, that today's date is 1st November. I plan to borrow a deposit on 1st Feb. So after 3 months till 1st June. 1st Feb to 1st June is 4 months. So after 3 months for 4 months, the relevant FRA is 3-7 at 4.82%. Okay. Three dash 7 at 4.82%. Okay, so let's start. You have to solve the FRA. If interest rates increase or decrease by 0.9, you need to show return on deposit or cost of borrowing, gain loss due to FRA, net return or cost. Let's start. Actual return on deposit. It's very easy. Actual return on deposit. I've told you the formula as well. Actual return on deposit. The formula of actual return on deposit is amount into rate of interest actual into time period over 12. So amount into actual interest rate into time period over 12. So what is the amount? $48 million. Amount is 48 million into rate of interest actual. What is the actual interest rate? So the question states we can invest funds at 4.09. We can invest funds at 4.09. Now one can invest funds at interbank rate less 20 basis points. The current interbank rate is 4.09. So we can invest funds at interbank rate 4.09 less 20 basis points. That means we can invest funds at interbank rate 4.09% less 20 basis points, 0.2%, 3.89%. You can invest funds at 3.89%. You can invest funds at 3.89%. Okay, pay attention. Actual term deposit amount is for 48 million. The actual rate of interest at which you can deposit, it's 3.89%. But pay attention, you are doing the case if interest rate increased by 0.9. So you can deposit at 3.89, but if interest rate increased by 0.9%, your deposit rate would be 4.79. If interest rates increase by 0.9, you can deposit at interbank rate 4.09 less 20 basis points, 0.2%, 3.89. But if they increase by 0.9, you can deposit at 4.79% into time period over 12. What is the time period? For how long you plan to borrow a deposit? You plan to borrow a deposit for 4 months out of 12 months. Okay, let's calculate the amount. It's 766. 400. Okay. Similarly, let's move here so that you get a sound idea. Let's move here. If interest rate decreased by 0.9, if interest rate decreased by 0.9, how to find actual return on deposit? Take the amount. What is the amount? $48 million into actual interest rate. Now you can invest funds at interbank rate 4.09 less 0.2%, 3.89. But if interest rate decreased by 0.9, your working is decreased by 0.9. You can invest at 3.89. If interest rate decreased by 0.9%, you can only invest at 2.99%. You can invest at 4.09 less 0.2, 3.89. If they decrease by 0.9%, you can only invest at 2.9%. Okay. Into time period. For how long you're planning to borrow a deposit? 4 months. Okay. What is the amount? Let's calculate. $478,400. Okay. This is the working of actual return on deposit. Take the amount into actual interest rate into time period. You need to deposit 4 months over 12. Actual interest rate. You can invest at 4.09 less 20 basis points, 3.89. If they increase by 0.9, it becomes 4.79. If they decrease by 0.9, it becomes 2.99. You can take any questions on that. Milovan, you will obviously take the contract when you want to borrow a deposit. And in currency, you take the contract when you need to pay or receive. It's the same. Okay, so I need to recommend a strategy in case interest rates increase or decrease. So I have to make 2 columns, interest rates increase column as well as decrease column. The format I've told you, it's actual return on deposit and gain loss due to FRA net return. It's a borrowing case, then actual cost of borrowing, gain loss due to FRA net cost. So I need to take actual return on deposit and then gain loss due to FRA net return. I've calculated the actual return on deposit, which it's easy. Take the amount, how much amount you're borrowing or depositing, 48 million. Into time period, for how long? 4 months. You are depositing on 1st Feb till 1st June, 4 months, over 12 months. Okay. Then, what is the actual interest rate? What is the actual interest rate? It's clearly written in the question that you can invest at interbank rate 4.09 less 20 basis points 0.2. So you can invest at 3.89. If interest rates increase by 0.9, we are doing the case interest rate increase by 0.9. You can invest at 4.09 less 0.2, 3.89. If they increase by 0.9, you can invest at 4.79. And if it decreases by 0.9, so you can invest at interbank rate 4.09 less 20 basis point 3.89, but you are doing the case where interest rate decrease by 0.9. So 3.89 is the rate if you do the case of decrease by 0.9, 2.9. So is everybody clear with how we got 4.79 and 2.99? $2.9 is also the same. You are doing the case if interest rates decrease by 0.9. So your rate is investing rate is 4.09 interbank less 20 basis points 0.2, 3.89. If it increases by 0.9, add it, becomes 4.79. If it's decreased by 0.9, so 3.89 is the investing rate, less 0.9%, it's 2.9. Now the big thing, gain loss due to FRA. Now pay attention to this. How do you find gain loss due to FRA? Look at the formula of gain loss due to FRA. Difference in interest rate into amount into time period over 12. Difference in interest rates into amount into time period over 12. Okay. Calculation would be easy. The calculation would be easy. The main thing, whether it's a gain or loss. So what is the difference in interest rate? If interest rates increase by 0.9, if interest rate increase by 0.9, the interbank rate was 4.09. If interest rates increase by 0.9, your rate become 4.99. If interest rates increase by 0.9, they became 4.99. But you are doing FRA. What was the FRA rate, the locked rate? 4.82. You're doing the FRA technique, right? So when interest rates increase by 0.9, take the difference in rates. The rates became 4.99. but you lock the rate FRA at 4.8 to take the difference in rates into amount 48 million into time period over 12, 4 by 12. Okay, the answer is, let's calculate, $27,200. Okay, I'm not sure it's a gain or loss. I'm just telling you the format. That how did you find gain loss due to FRA? Take the difference in rates. When interest rates increased by 0.9, they became 4.99. But in FRA, you lock the rate at 4.82 into amount into time period over 12. Okay, and come here. If interest rate decreased by 0.9, gain loss due to FRA, apply the format. Difference in rates. If rates decrease by 0.9, 4.09 was the interbank rate. If they decrease by 0.9, they became 3.19. If interbank rate was 4.09, if they decreased by 0.9, they became 3.19. But you did FRA at 4.82. This is the difference in rates into amount $48 million into time period. Let's calculate this. $260, 800. Okay, so one last question. How do you get gain or loss due to FRA? You take the difference in rates. If interest rates increase by 0.9, 4.09 was the interbank rate. If they increase by 0.9, became 4.99. But you booked FRA at 4.82 into amount into time period over 12, 27,200. If interest rates decrease by 0.9, how to get the gain loss due to FRA? 4.09 was the interbank rate. It decreased by 0.9, became 3.19. You book rate at 4.82 into time period over 12. The $1 million question. It's a gain or a loss, whether it will be added or deducted. Now listen carefully, it's a deposit case. When interest rates increase by 0.9, when interest rates increase by 0.9, they became 4.99. When interest rates increased by 0.9, they became 4.99. You could have deposited in real market at 4.99. When interest rates increased by 0.9, became 4.99. You could have deposited in real market at 4.99, but you blocked the deposit rate through FRA. You fixed the rate at 4.82. Market rates have increased. 4.99% are the rates, but you blocked the rate at 4.82. Due to rate fixation, due to FRA, you got a gain or a loss. It's a loss because the market rates are 4.99, but you blocked the rate at 4.82. Reduced rate, you suffered loss. What to do with loss? Loss reduces return. We have written return above. Loss reduces return. So deduct it. The net answer you will get by deducting here, it will be $739200. Pay attention. When interest rates increase by 4.99, remember it's a 0.9, it's a deposit case. The rates became 4.99, but you block the rate at 4.82 for deposit at a low rate. It's a loss. Loss reduces return. Deduct it. 739,200. Come here, right side. Gain loss due to FRA. It's a deposit case, right? When interest rates decrease by 0.9, they became 3.19. When interest rates decrease by 0.9, the market deposit rates became 3.19. But you lock the rate at 4.82 due to rate fixation FRA. When interest rates decreased by 0.9 in the market, the rates became 3.19%. You could have deposited at 3.19 in real market, but you blocked the rate at 4.82 higher rate. So did rate blocking give you gain or loss? More rate, gain. What to do with gain? Gain increases return, so add it. The net answer would be 739,200, and it's compulsory that both options, increase, decrease, produce the same answer, only then your solution is all right in FRS. That both produce the same answer. Okay, any questions you can ask, else you can note this down, and we will discuss the further techniques after a 10 minutes break. Okay, but I can take questions first and then go on the break. Okay. No, man, you are wrong. The 0.2% should only be considered when you are calculating the return. While gain loss, you cannot enter it multiple times. It would be a dual impact. Christina, because we are not calculating the return, this 20 basis points will only affect us when we deposit. If you include it in the gain or loss, it will have a multiple impact. 4.82 is the locked rate. You should look at the question. We took 3-7 FRA. So 3-7 FRA rate lock was 4.82. Extra 20 basis points, if you take at both places, it would have a dual impact. Okay, so quickly repeat it. Firstly, I told you to write 5 things: today's date, borrowing deposit date, ending date, what is the case, future, and option to take. So today's date is given 1st November 13, borrowing deposit date is 1st Feb 14, ending date is 1st June, cases of deposit, and which future and option to take, the March one. Okay, we are doing FRA technique since today's 1st November, and we plan to borrow and deposit on 1st Feb after 3 months till 1st June for 4 months. So 3-7 is the FRA rate, and the rate provided in the question is 4.82. The working format says if interest rate increase by 0.9 and decrease by 0.9, you have to take both of them. Okay, the format is actual return on deposit or cost on borrowing. It's a deposit case, return on deposit, gain loss due to FRA, net return. Actual return on deposit is easy. 48 million is the investment. If interest rates increase by 0.9, we can deposit at 3.89. 4.09 less 20 basis points. We can deposit at 3.89. If they increase by 0.9, we can deposit at 4.79. If they decrease by 0.9, we can deposit at 2.99 for 4 months. You get 766,400 and 478,400. Gain loss due to FRA, it's just the difference in rates, what you got versus FRA, into 48 million into 4 by 12. So in the first case, if interest rates increase by 0.9, they became 4.99, but you deposited with FRA at 4.82. So you booked a reduced rate than market. It's a loss, which will reduce your return, deduct it. But in the second case, if interest rates decrease by 0.9, the rates became 3.19, interbank less 0.9, but you booked at 4.82. It's a gain, and gain increases return. Okay. Malawan, please send your question again. Amsal, I think I have quite clearly stated the formats, and nowhere in FRA format basis comes. Nowhere in FRA format basis comes. It was only in futures and options format. Varsha, we will show. Rakib Zaman, okay, I will try. I told you before as well. If in were 3.19 and 4.82, how did we arrive at that? Now 4.82 is the FRA rate. That's not our arrival rate. It's given in the question. That rate will be blocked at 4.82. Okay, so 4.82 is the FRA rate given in the question. If interest rates decrease by 0.9, what are the current rates? Current rates are the interbank rates, 4.09. If the interest rates fall by 0.9, so 4.09 is the current rate. If they fall by 0.9, became 3.19. And if current rates are 4.09, it rises by 0.9, becomes 4.99. No, Salima, it's included in the FRA rate, all the commission. So if Rina, again, the same question, if interest rates increase by 0.9, the current rates, the interbank rates is the current rate, is 4.09. If they increase by 0.9, becomes 4.99. And in decreased case, 0.9, 4.09 is the current rate, decreased by 0.9 becomes 3.19. Okay, now you can take a break, 10 minutes break. And I'm sending a voice message on the WhatsApp group. I would appreciate if everyone listens to it. Okay. If Finwa WhatsApp group can be accessed later as well. When you just switch on your phone through WhatsApp, you can just take the link, copy paste the link, or this is my phone number. I'm messaging you. You can drop me a text even in the break or after the class. I can add you in the group. Malawan, I already answered you. I think maybe you just were copying. We never did this in FX hedging as well. In FX also, if we wanted to pay at first Feb, we tried to take that future. If we wanted to receive at 1st November, we would like to take that future. And same here, if we are borrowing or depositing on 1st Feb, the very next future will be taken. Okay, so we are resuming. Now we will be moving towards technique number 2. That is interest rate futures. As you all know, we discussed the format. The strategy in case of deposit is buy now, sell later. Buy now, sell later. This is the strategy in deposits. Buy now, sell later. Okay. Now in futures, we first need to make sure the format is there. Okay, so it involves steps. The first thing you need to do is to find number of contracts. In futures, the first step you need to show is number of contracts. Okay. The formula of number of contracts is borrow or deposit amount. What is the borrow deposit amount? 48 million. Over contract size. So what is the contract size in the question? 20 million. Into time period or borrowing of deposit, that's 4 months over 3. So find number of contracts. The borrowed deposit amount is $48 million divided by contract size, that's 2 million. Into time period of borrowing or deposit, that's 4 months over 3. This will give you a number of contracts. Let's calculate. It's 32 contracts. Okay, I have done the step 1. It's borrowed a deposit amount 48 million over contract size that was given in the question 2 million. Time period of borrowing, that was 4 months over 332 contracts. Okay, I will explain each and every step in detail. So step number one is done. Any problem with step 1, please ask. Step 2 is find basis risk. No, Shilpa. Jakir-san, why we are dividing with 3? Because I told you that futures and options are only available for 3 months. March, June, September, December. It's available for 3 months. That's what 3 signifies. Winston, for you as well. Okay, so what is the formula of basis risk? Spot price minus LIBOR less futures price which will be given. Spot price minus LIBOR less futures price which will be given. So what is the spot price minus LIBOR? Remember, spot price is always 100. Spot is always 100. No other chance. Spot is always 100. Spot minus LIBOR. LIBOR is the London interbank offer rate, the interbank rate. The interbank rate is 4.09. So spot 100 minus LIBOR less futures price, that's given. Which future did you take? You said here that we will take March 1. See, which future to take? March 1. So take the March future. The price of March future is 94.76. See, so spot minus LIBOR, that's spot is always 100, minus LIBOR, it's 4.09 interbank rate, less futures price. Futures price is 94.76, the March future. This is basis. Basis is also called the commission of the broker, the person who's giving you this deal, the bank or the money changer or the broker or the financial institution. $1.15. This is done with step 2. Spot minus LIBOR. Spot is always 100, less interbank rate 4.09, less futures price. You took the March futures 94.76. Okay. Any problem with 2 steps, please ask. So we are making it simple, and for that obviously we need a stepwise approach. So spot, Batul Bakar, I told you in the first class, it's up to you. You need to put answer in word processor or spreadsheet, up to you. Basis is basically the commission of the broker. So number of contracts, what's the first step? And basis risk, spot less LIBOR less futures price, that was the second step. Okay, any problem with 2 steps? Then move towards the third step. Find unused basis. In the third step, you need to find unused basis. Now this is a bit tricky, so please pay attention. Unused basis. The formula of unused basis is, see, basis risk into extra months over total months. Basis risk into extra months over total months. Now this is a bit tricky, please pay attention. So basis risk 1.15 just calculated into extra months over total months. What is this extra months? Pay attention, please. You needed to borrow or deposit on 1st Feb, right? You needed to borrow or deposit on 1st Feb. So you wanted a future contract of 1st Feb. Okay, you needed to borrow a deposit on 1st Feb. So you wanted a futures contract of 1st Feb. There is no possibility. You only get for December, March, June, and September 30th. So listen carefully. You needed to borrow or deposit on 1st Feb. Look at my fingers. So you wanted a future of 1st Feb, but you didn't have it. You only had for 30th December, 30th March, 30th June, 30th September. So you took 30th March future, 30th March future. So don't you think you needed to borrow a deposit on 1st Feb? You needed a 1st Feb future, but you had to take the 30th March future. Isn't it 2 extra months? 1st Feb to 1st March, 1 extra month, and 1st March to 30th March, 2 extra months. So it's basis risk, 1.5 into extra months, that's 2 months. I'm repeating this 2 months again. I needed to deposit or borrow on 1st Feb, so I needed a future of 1st Feb. But I have to take the March 30th one. So how many extra months? 1st Feb to 1st March, 1 month. 1st March to 30th March, 2 months. 2 extra months over total months. What is the date today? Today's date is 1st November. And you took future of 30th March. Today's 1st November, and you took a future of 30th March. Count the months. 1st November, 1st December, 1 month. 1st January, 2 months. 1st February, 3 months. 1st March, 4 months. And 30th March, 5 months. So total months are 5. This equals 0.46. Repeat. Number of contracts was easy. Borrowed deposit amount, you need to learn the formulas to be able to grasp. Borrowed deposit amount is 48 million, over contract size 2 million, into time period 4 months over 332 contracts. Basis risk spot 100 less LIBOR interbank rate 4.09, less futures price is given, you took the March future 1.15. Unused basis, the basis risk 1.15. Extra months over total months are a bit tricky. How to get the extra months? You needed to borrow a deposit on 1st Feb. You should have taken the contract of 1st Feb. Not available, took for 30th March. So 1st Feb to 1st March and then 30th March, 2 extra months. Total months. Today's date is 1st November. You took for 30th March, 5 extra months, 0.46. Any questions with first 3 steps? Yes, Arun, you can do that. For us, basis risk is just the spot minus LIBOR less the futures price. Basis risk is the commission of the broker. Okay, I'm just repeating this 2 and 5 again. So it's basis risk 1.15 into extra months over total months. So extra months over total months. How do we get extra months? Today's date is 1st November. We plan to borrow a deposit on 1st Feb. If we plan to borrow a deposit on 1st Feb, so we needed a future of 1st Feb, but we took it for 30th March, always 30th. So 1st Feb, you needed to borrow a deposit, you needed for 1st Feb, but you took it for 30th March. It's 2 extra months. 1st Feb to 30th March, 2 extra months. Over total months. Today's date is 1st November. Today's date is 1st November, right? And you needed the future, you opted the future of 30th March. So today is 1st November, you opted for 30th March. So 1st December, 1st January, 1st February, 1st March, and 30th March makes 5 months. You can count it. Today is 1st November. You took it for 30th March. So till 1st December, 1 month, 1st January, 2 months, 1st February, 3 months, 1st March, 4 months, 30th March, 5 months. Okay. Now it's very surprising that always remember, these are exam preparation webinars. Obviously, exam preparation webinars means Pay attention to this. This is what I send in the voice note as well. Exam preparation webinar means that webinar sessions believe that students must be prepared for exams, and it's just a go through of quickly of important topics. Obviously, you all know that we can't cover each and everything, each and every part, not possible. We are very short, much short of time, only 15 hours. I have to answer your questions as well, which you keep on asking during the webinar. In every class, we are hardly able to complete one topic. Now, remember one thing. There are some students, I don't intend to disrespect anyone, but there are some students who are at the moment asking, their exams are just a few weeks away. What is basis? So before coming to webinar, you must know the basic terminologies, else the things would sail over your mind. However, I just want to help all of you. So I have sent it in the voice note, but some of the students are unable to join the WhatsApp group. Therefore, I'm sending here. Like when we teach on online classes, when we teach in our classroom-based classes, this interest rate risk management topic, it's a very, very complicated topic. You all must have got an idea. So we used to teach 6 to 7 past paper questions to students. Then they get a complete grasp, complete command on how things work. These 6 to 7 past paper questions, and you're hardly able to complete one question in a class. So anyways, I have those lectures with me. If any one of you wants help, he can message me on WhatsApp and we can help him out through 1 or 2 more questions so that they get a complete crystal clear idea of how these interest rate risk management and currency risk management works. Okay. So now the step 4. Step 4 states, find future closeout price in both cases. Okay. You need to find future closeout price in both cases. What are the 2 cases? There are 2 cases in the question. Interest rate increase by 0.9%. Interest rate decrease by 0.9%. The step 4 specifically asks, find future closeout price in both cases. So one case is interest rates increase by 0.9 and the other case decrease by 0.9. So what is the formula of future closeout price in both cases? It's spot minus LIBOR less unused basis. Spot minus LIBOR less unused basis. What is the spot? $100 always minus LIBOR. LIBOR is the interbank rate. So what is the interbank rate? 4.09. What is the interbank rate? 4.09. But here it's the case of increase by 0.9. Spot 100 minus LIBOR. LIBOR is the interbank rate, it's 4.09, but you are dealing the case if it increases by 0.9. So it becomes 4.99. Less unused basis. What is the unused basis? 0.46. This makes it, let's calculate. 94.55. Okay. And in the second case, future closer price in both cases. Second case, spot. So spot is 100 minus LIBOR. LIBOR is the interbank rate, 4.09, but if it decreases by 0.9, if it decreases by 0.9, comes 3.19, spot minus LIBOR, less unused basis. So unused basis, you just have calculated 0.46. This becomes 96.35. So it's spot minus LIBOR, less unused basis. Spot is 100. LIBOR is interbank rate 4.09, but if you are dealing with increased case 0.9, becomes 4.99. If it decreased case of 0.9, 3.19. Step 4 is done. Any questions? If and why, I'm just changing the screen. If you look at the question format, the future closeout price format is spot minus LIBOR, less unused basis. So you have just calculated unused basis in the above step, 0.46. FNWA, I told you one thing that if you look at the formula, I'm changing the screen of future closeout price. You can see it's spot minus LIBOR in the bracket, less unused basis. So 0.46 is the unused basis. How did we get it from? We have just calculated that in step three, sorry. In step 3, you calculated unused basis. So it's spot minus LIBOR less 0.46. No, Janko Bass, you are wrong here, dear. That's not how it works. Aslan Jawad, total months. Today's date is 1st November, and we took future of 30th March. So you can count it's 5 months. 0.46 is right in third step, the unused basis. I have sent this file on the group as well, where all the formulas are given. Here's the screen, basis risk into extra months over total months. I have sent this sheet on the WhatsApp group as well. Okay, now in the step 5, I need to calculate the tick if it's not given in the question. So I can see tick is nowhere present in the question. I read the question, there is nowhere tick is mentioned. So I need to calculate the tick. Look at the formula of tick. Contract size into 1 over 10,000 into 3 by 12. Contract size into 1 over 10,000 into 3 by 12, as you can see on the screen. So contract size is $2 million into 1 over 10,000 into 3 by 12. We get the tick, which is the fluctuation lot. $50. So I will just be repeating 5 steps. If you have any questions in 5 steps, you can then ask. We're doing technique number 2, interest rate futures. Since it's a deposit case, it's buy now, sell later. Okay. So the first step is number of contracts, which is 48 million contract size over 48 million amount over contract size 2 million into time period 4 months over 3, it's 32 contracts. Basis spot 100 minus LIBOR, the interbank rate 4.09. Less futures price. Which future you selected? The March one already written in the first step, 94.76, 1.15. Unused basis is the basis risk 1.15 into extra months over total months. Extra months, you needed to borrow a deposit on 1st Feb. You needed a future of 1st Feb, but you took for 30th March, 2 extra months. Over total months, today's date is 1st November, and you took for 30th March, it's 5 months. Future to dollar price in both cases, the formula is both cases increase or decrease. Spot 100 minus interbank rate 4.09, increase by 0.9 becomes 4.99, plus unused basis 0.46. And if it decreases by 0.9, spot 100 minus interbank rate 3.19 if it decreases, plus unused basis, and then you found tick. Second last step. It states find outcome of hedge in case of LIBOR increase and decrease. LIBOR is the interbank rate. I need to find outcome of hedge in case of LIBOR increase and decrease. There are 2 cases. Interest rate increase by 0.9%. Interest rate decrease by 0.9%. So 2 cases, interest rates increase by 0.9 and interest rates decrease by 0.9, because the step 6 requires find outcome of hedge in case of increase and decrease. Okay, so what is the format? You need to take actual cost of borrowing or actual return on deposit. It's the same. You already did the actual cost of borrowing or actual return on deposit. It's a deposit case, so will be actual return on deposit, and here also actual return on deposit. Okay, then it's gain loss due to futures and you get net cost of return, you get net return. That's what the format states. You can check the format. It's actual cost of borrowing or actual return on deposit. Add or less gain loss due to futures. The formulas are given. You get net cost of return. It's a deposit case, so net cost of return. Okay. Now you need to pay attention to 6 steps. The first step is very easy. Actual return on deposit. What is the formula? Amount into interest rate into time period over 12. So what is the amount? 48 million. Interest rate. At what rate you are depositing? 4.09% is the current interbank rate. You are doing the case if it increases by 0.99, becomes 4.99, but you can deposit at 20 basis points, 0.2% less. So remember, as you did before, 4.79%. 48 million is the amount into interest rate. You can deposit at interbank rate 4.09 less 0.2%, 3.89. But if it increases by 0.9, becomes 4.79 into time period 4 months over 12 months. This makes it, we have calculated this before, 766,400. Okay, come at this case. Actual return deposit. What is the deposit amount? $48 million into what is the interest rate? You can deposit at 4.09 less 0.2%, 3.89. If it decreases by 0.9, you can deposit at 2.99% into time period 4 months over 12 months. $478,400. This is exactly what we did before. So if you have any questions with this step, you can ask. Actual return on deposit, it's the amount 48 million into rate 4.79 into time period over 12. Any questions? Then I will do the main thing, gain loss due to futures. Jankobas, your calculation is wrong. It's 50. Shilpa, actually, I get your question that you are saying that since it is not for first timers, we should speed up the process. It is not for the first timers, you're right. But obviously, we have a tendency of students who usually tend to study right at the end. And unfortunately, they're in majority. So I can't just rush up or speed up to a question. Even you know that the speed I am moving in, there are one or two comments who say that it's very fast, please be slow. Not more, roughly 200 students, but one or two even find this one as fast. So if you're saying I or advising me to rush, I can't just rush towards questions. These are very tricky things. However, that's the reason, because we are unable to cover everything in this webinar. That's why I created the WhatsApp group. You can ask anything there. No need to worry. Okay, so the last thing, gain loss due to futures. Now look at the formula of gain loss due to futures. It's difference in futures contract price and future closeout price into spot into number of contracts into tick. So you need to take the difference between futures contract price. Remember, you took futures of March. So March futures contract price is 94.76 given in the question. You took the March futures contract. Difference in futures contract price 94.76 and future closeout price. In this is the increased case. Remember, in increased case, you just calculated in step 4 the future closeout price 94.55 into spot 100 into contracts 32 into tick 50. I get the answer. See the formula. Difference in futures contract price. The futures contract price was 94.76. We took the March future. Remember, we wrote right at the start that March future 94.76. And future closeout price. The future closeout price in increased case is calculated in step 4, 94.55 into spot 100 into contracts 32 into ticks 50. This makes it 33,600. Okay, and come this side. I'm not sure it's a gain or loss added deducted, but it's difference between futures closeout price and futures contract price into spot into contracts into tick. And here, gain loss due to futures, apply the formula. Difference between futures contract price. Remember, futures contract price was the March future, 94.76. And future closeout price. This is the decrease case. In step 4, you computed the futures closeout price of decrease case. Into spot 100 into contracts 32 into tick 50. What is the answer? $254,400. So the formula of gain loss on futures is the difference between futures price and futures closeout price. So futures price is 94.76 as we took March futures, and future closeout price are computed in step 4. Increase case is 94.55 into spot into contracts into tick. And at the right side, the futures closeout price is 94.76. Take the difference with futures closeout price. The closeout price in decrease case is 96.35 as in step 4 into contracts into tick into spot. I get the answers. It's a gain or a loss. The $1 million question, it should be added or deducted. It's a gain or a loss. $1 million question, added or deducted. So, what is the strategy of futures? The strategy is this. I am highlighting it with red mark, which you wrote in step number, even before starting. The strategy is buy now, sell later. So come here to gain or loss on futures calculation. The strategy is buy now, sell later. I'm just mentioning for your reference, buy now, it's B, and sell later is S. So buy now for 94.76 and sell later for 94.55. Buy now for 94.76, buy for 94.76 and sell for 94.55. Buy for 94.76 higher and sell for 94.55 lower. Buy for 94.76 higher and sell for lower. It's a loss. Loss will reduce return. Deduct it. Your final answer is gonna be 732,800. Okay, and come this side. Gain loss due to futures on the right side. The strategy is buy now, sell later. Buy now for 94.76 and sell later for 96.35. Buy for lower 94.76, sell for later 96.35. Buy for lower, sell for higher. It's again, if you buy for lower and sell for higher, it's again, gain increases return, add it. 474,800 plus 254,400. The net return is $732,800, and like the FRA, the futures answer is always gonna be matching as well in both cases. The futures answer is also gonna be matching in both cases. In both cases, the answer coming is 732,800. Move towards the last step, then we will end the class and ask any questions from you. Effective rate, pay attention. The formula of effective rate is very easy. Net cost of return over borrowed deposit amount into 12 over time period. So what is the net cost of return? Both options are giving the same net cost of return. $732,800 over borrowed or deposit amount, that's 48 million, into 12 months over time period of borrowing. So 12 months over time period of borrowing is 4 months. It's 4.58%. This is the principal presentation of futures in front of your screen. If you have any questions, please ask. Especially the gain loss due to futures. Buy now, sell later. In the first case, buy for higher, sell for lower, it's a loss, which reduces return. The second case, buy now, sell for higher later, it's a gain. Any questions, please? There's no time to complete options today. However, we'll do options in next session and then move towards the next issue. 100 is a spot. FNI, that's what I was telling Shilpa about. 100 is the spot. Sandon, we aren't taking any negative sign and positive sign. We are just not rote learning. We are discussing with logic. That if it's buy now for lower and sell for higher, it's a gain. And if it's buy for higher, sell for lower, it's a loss. We are not considering the negative positive time Ritu Parna. We're discussing the logic. Yes, Mira, it's the same. Step 7 is the effective rate formula. It's the net cost or return. What is the net cost or return? 732,800 over borrowed or deposit amount, that's 48 million, into 12 months over time period, that's 4 months. 4.58%. You just converted your answer 732,800 into percentage. And I think if you follow the 7-step approach, I'm quite sure that you won't be facing any problems in futures. You need to practice more, obviously. You can take help from me in the form of lectures as well, which I told you for further questions. But It's going to be very easy if you follow this 7-step approach. Yes, return is always the same. Yes, for us, we will do it tomorrow. Plain Baker, we will do it tomorrow. Batul take carries marks. You have to show that. Yes, Salima, you're right. Requirement of the question, Elmir. Esra, that's what hedging is all about. Either it increases or decreases. In both cases, you get the same. Your risk is protected, your loss is protected. Either interest rates fluctuate in your favor or against. Okay, so thank you very much. See you all tomorrow.